Most people think World War II was only about battles, tanks, and geopolitics. But quietly, behind the front lines, something else was being built, something that still controls how your money moves today. World War II didn't just redraw borders. It created the foundation of the modern banking system we live under right now. Before World War II, global banking was chaotic. Countries ran on the gold standard, meaning money was tied directly to physical gold reserves. Banks failed often, currencies collapsed easily, and international trade was slow and risky. The Great Depression had already exposed how fragile the financial system really was. Governments didn't trust each other, central banks acted independently, and when crises hit, there was no coordinated response. Then World War II changed everything. Fighting a global war is expensive, unimaginably expensive. Governments needed massive amounts of money, fast. The United States alone spent more than $4 trillion in today's dollars during the war. To fund this, governments stopped relying on gold and started borrowing on an unprecedented scale. War bonds became common. Citizens were encouraged to lend money to their governments, creating a direct link between national banking systems and the public. This was one of the first steps toward modern government debt markets. But the real transformation happened before the war even ended. In 1944, while the fighting was still ongoing, 44 Allied nations met in a small town called Bretton Woods in the United States. Their goal was simple but revolutionary: make sure the world never falls into another Great Depression or financial collapse again. What they created there became the backbone of modern global banking. The Bretton Woods system introduced fixed exchange rates, with the US dollar at the center, backed by gold. Other currencies were tied to the dollar, and the dollar was tied to gold. This instantly made the US dollar the world's reserve currency, a role it still holds today. It also created two institutions you've definitely heard of: the International Monetary Fund and the World Bank. The IMF was designed to stabilize currencies and prevent financial crises. The World Bank was created to fund reconstruction and development. These institutions turned banking into a global, coordinated system rather than a national one. After the war, Europe was financially destroyed. Entire economies had collapsed. To fix this, the US launched the Marshall Plan, sending billions of dollars to rebuild European countries. But this wasn't just aid. It forced nations to modernize their banking systems, standardize financial reporting, and integrate with international markets. Banks became tools of economic policy, not just places to store money. At the same time, central banks gained power like never before. During the war, governments realized they needed full control over money supply, interest rates, and credit. After the war, this control didn't disappear. It became permanent. Modern central banking, where institutions like the Federal Reserve actively manage inflation, employment, and economic growth, is a direct result of wartime financial coordination. Another quiet but massive change was regulation. Before WWII, banks operated with relatively loose oversight. After seeing how unchecked speculation helped cause the Great Depression, governments imposed stricter rules. Banking became safer, but also more centralized. Depositor insurance, capital requirements, and government backstops all became standard. This is why today your bank deposits are protected and why banks don't collapse overnight like they once did. World War II also reshaped how money moves globally. International payment systems expanded. Correspondent banking networks grew. Over time, this evolved into modern systems that allow money to move across borders in seconds. The financial globalization you see today, foreign investments, multinational banks, global markets, can all trace their roots back to post-war banking reforms. Even modern debt culture comes from this era. Governments learned that borrowing wasn't just a temporary wartime tool, it could be permanent. National debt exploded during WWII and never truly went back down. Today's massive government debts, deficit spending, and stimulus packages are all descendants of wartime financial strategy. So when you swipe your card, take a loan, invest in stocks, or watch central banks raise interest rates, you're interacting with a system shaped by World War II. A war that forced governments to innovate financially, centralize power, and build institutions that still dominate the global economy. World War II didn't just change who ruled the world. It changed how money itself works. If you want more stories where history explains modern finance, subscribe to the channel. Drop a comment and tell me, do you think today's banking system makes economies safer or just more dependent on debt?